What happened to the Greek bailout money? Thank you for joining us for another Bank of Cardiff newscast. This is a big week for Greece and the European Union. For the past few months, there have been endless negotiations between Greece's newly elected Syriza government and the troika of lenders that have been providing fiscal support since the financial crisis. The talks have been bloody and acrimonious, with Greek leader Alexis Tsipras accusing other EU leaders of blackmailing his country into accepting impossibly punitive austerity measures in return for continued, if fragile, solvency, and IMF President Christine Lagarde doggedly sticking to the payback schedule. With entrenched positions on both sides, talks have broken down, and everyone faces a nail-biting wait to see what will happen before Greece's next loan payment is due. There's a very real possibility of a Greek exit, or as they say, Grexit, from the single currency and from the Union itself if Greece defaults on its debts. So, how did Greece get into this situation? Well, only a tiny percentage of the €240 billion bailout money Greece received in 2010 and 2012 in the wake of the financial crisis of 2008 actually ended up in the government's purse. In fact, most of the money went to the banks that lent Greece €310 billion before the crash. As a result, Athens was unable to run up a budget deficit, as did its European neighbors, instead being forced to dramatically reduce its deficit by reducing public spending. The lending troika, the International Monetary Fund, IMF, European Commission, and European Central Bank, ECB, produced a second bailout that revolved around a €100 billion debt write-off by private sector lenders. The value of bonds dropped by around a half, and the debt was exchanged for securities with a lower interest rate. Now, this swerved a chunk of the debt, but also added a further €30-odd billion to the Greek debt in inducements to have the deal accepted. Big losses were sustained by Greek pension funds. A further €48 billion was used to bail out Greek banks, and a hard-stopping €140 billion went to pay the original debts and interest. In total, less than 10% of the bailout money was available for use by the government to help reform the country's economy and to protect its welfare services. So, what now? The Greek government debt is now a whopping €320 billion, almost 80% of which is owed to its three main banking creditors. This is what has proved to be the sticking point for Tsipras and Finance Minister Yanis Varoufakis. They argue that by agreeing to a long-term cycle of punitive austerity measures, they are consigning the country to perpetual poverty, with no end in sight. It's hard to see a positive outcome for either Greece or the rest of the EU, but Tsipras vowed to let the people decide by holding a referendum on July 5th, and the stakes couldn't be higher. Join us later this week for another Bank of Cardiff newscast. And remember that all our newscasts are available on our website. That's www.bankofcardiff.com/newscasts.